Municipal bonds may not grab your attention right away. However, they could play an important role in certain portfolios. Credit conditions, according to today's guests, are the best in 20 years. So can this muni credit trend persist given the current climate that we're in? We're going to break it all down for you right now on UBS Trending. Hey everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us today. Joining me today is David Hammer, Global Portfolio Manager, Lead Portfolio Manager of Municipal Bonds at PIMCO. David, great to have you back with us. How are you?
Hey Anthony, thanks for having me.
Of course. So David, listen, it's been a really, talk about an interesting time for municipal bonds. I mean, given where we are in the credit cycle with outlook for the Fed, we're looking at, yield curves that have been inverted for 2 years on the Treasury side. So given all of that and the fact that we're looking at continued supply demand opportunities here, what's your macro view right now on muni bonds?
Well, on the macro side, the U.S. economy has continued to really outperform other developed markets, and that, of course, has helped to keep inflation a bit higher. Inflation is coming down in many overseas markets. It's moving in the right direction, but a bit more slowly here in the United States. PIMCO, that base case of the Fed's next move being lower, an economy that is slowing, not crashing. I think we've seen some of that in the recent data, job openings ticking up, a bit softer ISM number. We're all looking at CPI later this week. It certainly puts us on a course, which is a relatively soft landing, really good for risk markets, for bond markets. But the tail scenario that we spend a lot of time thinking about here at PIMCO is one in which the Fed has to stay higher for longer, and the consequences for the U.S. economy, they grow as tighter monetary policy gets passed through to the broader economy. And of course, that would mean a risk of wider credit spreads, things breaking. And what we really like about the muni market within our macro framework is at current yield levels, earning 4 to 5% tax-free in a relatively high credit quality asset class. The carry alone, the yield alone is very attractive. But in addition to that, in a scenario in which the economy struggles more than what's expected, investors are better protected in municipal credit allocations than they are in corporate bonds or some of the riskier parts of the market.
Yeah, it's interesting, Dave, because recently I saw an interview with you that you were doing, and you talked about how maybe this is about a month ago that we're seeing the best credit conditions in 20 years. And then you look at supply; it's risen pretty substantially. Yields are on the rise. So how does muni credit look today, and do you expect this kind of trend that we're seeing to persist, given where we expect that soft landing, and now we're pricing in here 25 basis points 2 times before the end of the year with the Fed, 2 cuts, I should say, 2 25 basis point cuts. How does that look for you when you look down the other half of the year here?
Yeah, muni credit remains in the best shape it's been in 20 or 25 years. And the short story there is that policymakers during COVID expected that tax collections of all kinds, sales taxes, property taxes, income taxes, they would decline by 10 or 20%. In reality, they're 30% above pre-COVID levels. The pandemic relief that was rolled out, $360 billion worth, it is yet to be fully allocated or spent. Only about 2/3 of it has been spent. That will continue to flow through 2026. At the local level, property taxes have a long way to go to catch up with house price appreciation. Last year, property taxes were up nationwide about 7%. That's double the average of the previous 10 years. It's not great news for homeowners, but for muni bond investors that get repaid by those property tax collections, we see that as really a tailwind for credit. And then the other element that I find really interesting is pension reform. Pension liabilities have come down over the last decade at the state and local level. Many state and locals, they've recognized the big holes in their pension systems. They've begun to fully fund them. It's not perfect, but it's headed in the right direction. A lot different than the federal government, where entitlement reform is a little bit further out into the future. So muni credit, as a whole, looks really good. There are some exceptions, big cities where maybe economic activity has not recovered to pre-COVID levels. the transportation systems that support them. And then some sectors where wage inflation has been particularly challenging, not-for-profit healthcare, senior living. Those are areas that we recommend more caution.
Yeah. Thanks, David. So it's interesting, looking at credit quality, here at our chief investment office, our muni team expects that to remain stable. So from a credit perspective, how does what you see and even what we're seeing here translate to positioning? Where are the opportunities right now?
Yeah, we really think the best opportunities are, really where the banks used to be and no longer are in the muni market. So I'll start with the curve. The muni curve is very, very steep, about 80 or 90 basis points of positive slope between 10 and 30-year maturities. And a lot of that is driven by U.S. retail that's come back to very, very short maturity munis inside of 10 years. But U.S. banks that used to be big buyers of the long end, their tax rates lower today. They're buying less. And as a result, there's a steeper curve, and that's a good opportunity for muni investors. In some credit portions of the markets, we've seen really similar supply and demand imbalances. So multifamily housing bonds are one of our favorite sector allocations today. There are many tax-exempt bonds that are mortgages that are backed by Fannie Mae or Freddie Mac. And they're trading at a big discount to more generic AA rated muni bonds. Investors can earn 4 to 4.5% tax-free on 10 to 15-year maturities today. That's about 100 to 150 basis points above more generic plain vanilla munis. And banks used to be big buyers of those mortgages. They're buying less, again, because their tax rates are lower. And then in our high risk portfolios, we've seen really great opportunities to step into the void where banks used to do a lot of direct lending to some of these multifamily housing projects. We've had great success sourcing private placements, helping to structure some of these deals ourselves on still what we view as a credit quality instrument. Tax adjusted, you'd have to really take a lot more risk to get that same after-tax yield. So those are some of our favorite opportunities today.
Yeah, and it's when you look at that, you were talking about the muni curve and the fact that it's so steep, and you look at other curves out there, they're either flat or inverted, which we talk about here pretty consistently. So it's incredible to see how munis have just performed in such a different way. But let me ask you this, David, because there's a lot of fundamental news that's out there. You talked about the housing market, and there's other factors here, the Fed, but there's also a big election coming up in the U.S. this year. And if the matchup is what it is today, which is Biden versus Trump, each of those two candidates has very different thoughts on taxes and implications and potential trade tariffs. Are there any implications based on what you see fundamentally, including the election, that muni investors should be aware of?
Yeah, well, the big one is corporate tax reform. The reason that banks, insurance companies have been buying less in the muni market, they used to own a third, that's now down to about 25%, and probably will continue to head lower. It's because corporate tax reform in 2017 moved their tax rate from 35% to 21%. PIMCO's house view is that under a Trump presidency, we're likely to see those extended, so that would be no change. And even under a Democratic president, we're likely to see the corporate tax rate move up nominally. So maybe from 21 to 23 or even 25%. That would bring a little bit of demand back to the muni market. But, I think our house view is really it's neutral to net positive, regardless of the outcome of the presidential election. This is really different than where we were back in 2016 and 17 when the prospects of much broader tax reform were on the table. So really less risk in this election than we've seen in the last few cycles.
David, thank you so much. Always good to get your insights, and we really appreciate you coming by today. Good to see you.
Thanks so much, Anthony.
Thanks, David. David Hammer again, lead portfolio manager of muni bonds at PIMCO. So we, of course, want to thank Dave and all of our great partners over at PIMCO. Plus, thank you for tuning in today. For more information on what we're talking about here from our Chief Investment Office, particularly with the muni market, which does align very well with exactly what David was talking about, please visit our website at ubs.com/views. Plus, you can follow UBS on social media. We're on all the major channels, including Instagram. You can follow us at UBS Trending. And again, if you have any questions about what David and I spoke about today, make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you all a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon.